A market update for Wednesday, June 21st, 2023. We'll look at a big week for inflation and the Fed. Stocks rally with an S&P update. We'll go over U.S. housing prices and why is U.S. housing supply so low. Update on the Fed mandate with inflation and jobs, and we'll look at bull and bear behavior. And then finally, what to expect for the second half of 2023. Here's the chart from last week with the S&P 500. We discussed that we thought the October 2022 low was the low with the S&P 500 at 3,500, and that we've climbed a wall of worry into June to around 4,200. And then the question was, are we going higher to 4,800? Will we stay around 4,200 or drop back down and test the lows and maybe even go lower into the 3,000 to 3,500 layer? Of course, most critical with our discussion is inflation levels. US May headline CPI hits 4%. That's 11 consecutive months of falling headline CPI. So almost certainly we're going into the 3% range for July and August and could be in the lower threes very soon. Here's a different graph showing the same peak at 9.1% in June of 2022 and then a rapid fall. You can see we're trending very quickly down to the 2% range. We may not get there, but I think the Fed would be happy anywhere between 2 and 3%. For anyone still bearish that's wondering or can't understand why stocks are rallying, I think this shows how drastic the decline has been with headline CPI. The following day after the 4% May CPI result, Jerome Powell and the Fed confirmed that they would pause rates for June. And last week we had a very broad market rally, whereas previously it had only been FANG plus Tesla and Nvidia. About 7 stocks were leading the market. We've now had a more broad gain with a large number of the S&P 500 above their 20-day moving average. Small speculators have been heavily short the market for about 6 months now, and especially most recently, I think a lot of them realize they're offside and their short positions are getting squeezed. On top of that, they're still short, and so it indicates that we're going to have perhaps a squeeze and prices go higher on the S&P as these traders realize the market is going the other direction. As we covered in the last video last week, house prices in the US have started to rise again in 2023, and they never really went below the 22 levels. So we've had a small pullback, but we're still up. It's important to note that the fact that prices have not fallen below 2022 levels means most owners have positive equity in their homes. So they're much less likely to sell or walk away from the property just because mortgage payments have risen. This is what happened in 2008, and we're just not seeing that right now. In 2022, we saw a very large decrease in the volume of house sales, but we did not see prices fall. And the reason is supply. So there's just simply not enough houses to buy in the US. And so prices have not fallen with the sales drop off. This quote from Michael Zuber on Twitter, his argument is that the reason there's no supply for housing in the US is that the Fed actually broke the housing market. And what he means is that the Fed kept rates so low for so long. They had rates at 1% or 2% for such a long period of time that the majority of homeowners have locked in very low mortgage rates and therefore are not affected by the most recent higher mortgage rates. So he has 82% of homeowners having a mortgage below 5%, 62% of homeowners have a mortgage rate below 4%, and as much as 23.5% of homeowners have a mortgage rate below 3%. So they're not feeling pressured by these higher rates. Only the marginal buyer getting a mortgage very recently is actually feeling the heat of the higher 6 to 7% mortgage rates. So this means the higher interest rates are not affecting the majority of homeowners, and they're happily locked into lower rates. Furthermore, this decentivizes them from selling their house, because if you sell your house with a 3% mortgage and then have to refinance a new house at 7%, it just doesn't make sense. So people are holding on to their houses and weathering the storm, as it were, and people are just not putting their houses on the market. Less supply on the market means prices definitely don't fall, and as you can see, they're actually rising. And this just came in Wednesday. The US May housing starts are up 21.7% from April. This is a 3-decade high. So we had an enormous jump in housing starts for May. So new houses are being built. So house builders are being asked to build new houses simply because no one is selling pre-owned houses. So this is a further confirmation that the housing market is not only falling, it's actually rising. Moving on from housing, this is the DXY. It's US dollar strength versus a basket of other currencies. You can see we're falling quickly back to the blue line, which is the 200-week moving average, which is DXY at around 98. And this is very good for risk-on assets, stocks, gold, and others. As the US dollar becomes cheaper, people move into higher risk assets. Here we have the December 2023 forward-looking Fed rate expectations. So market participants are saying there's an 85% chance we are not much higher than current rates at 5%. 8% of responders had us lower than current rates. So on net, the conclusion is that rates have topped likely at 5% and are not going higher at least for a year or two. So the next question is, are we getting a recession in the next 6 to 12 months? Bears have been talking about a recession coming for almost a year now. It hasn't come, but they'll keep pushing and pushing and pushing that the recession is coming, the recession is coming. So let's go over a checklist here to answer the question, are we getting a recession or not? So inflation is falling fast. The Fed rate has likely topped at 5%. Corporate earnings are okay. Jobs are okay. Consumer spending is okay. Housing is good and even strengthening. The DXY is falling. Stocks are rising, which creates a wealth effect and positive sentiment. And then we have 2024 as an election year. The Fed says it's not a political entity, but they do tend to avoid getting in the way of politics. If they were to tighten rates in 2024 and cause a crash in the economy, that could quite possibly tip the election away from the Democrats. And so my impression is the Fed would avoid severely changing economic policy in 2024. So will we get a short-term pullback in the next 4 to 8 weeks? I think it's very likely. We've had a big move to the upside, and we'll likely go back. We could even test the 200-week moving average later in the year. But my Non-financial advice is you should buy that dip and that we're likely going towards all-time highs and might break the all-time highs by the end of the year. So you can see the blue line is the 200-week moving average on the S&P, and I've sort of followed that trend upwards. Little green line extension. You can see the 200-week will be going towards 4,000, 4,200 by the end of this year, and so that could be a support level looking forward. It's something to watch. Whether we test that level again, probably not, come to think of it, before the end of 2023, but it could be a test in 2024 or 2025. Good chance we're going up into that green circle and an all-time high test of 4,800. Wrapping up the video, just a quote here on bulls and bears, and this being relevant to what we've seen. So in a bull market, bulls get stubborn at the top and refuse to believe the market is topped. They hold on until prices are much lower, and then they finally capitulate. What we've had recently is the inverse of that. We've had bears that have been stubborn and refusing to believe the market bottomed in October of 2022. They stay out of the market until prices are much higher, and then they finally capitulate. So I think we're going to have more bears capitulating in July. Some of them will be squeezed out of their positions, and the sentiment will start to change. The news headlines will change, and we're going higher. Thanks for listening. You can find me on Twitter at Gresham's Law 7.